Here's the brutal truth that will save or destroy your trading account. 90% of retail traders lose money, not because they lack indicators, but because they're watching the wrong signals entirely. While amateurs chase predictions and hope for the best, professionals like Jesse Livermore, who made $100 million in 1929, while others jumped from windows, never predicted anything. They simply observed 3 specific indicators and let the market tell them what to do. The fundamental difference between amateurs and professionals isn't intelligence or capital, it's identity. Amateurs ask, what will happen? Professionals ask, what is happening right now? This distinction made Livermore one of the greatest speculators in history, while his contemporaries went broke trying to outsmart the tape. Picture this scenario that destroys accounts daily. You see a breakout on your favorite stock. Volume looks decent. You buy with $5,000, half your account, because you're confident. 2 days later, it's underwater. You widen your stop loss because it just needs more room. The stock sinks further. That's not bad luck, that's amateur behavior. A professional would have risked 1% of their account, waited for proper confirmation, and cut the loss fast when the tape spoke differently. While you lost $2,200 chasing hope, the professional lost $100 following discipline. This difference compounds into the chasm between consistent profits and devastating account destruction. But here's what most educators won't tell you. The problem isn't your strategy or indicators. The problem is you're trying to predict what the market will do, instead of observing what it's actually doing right now. Every amateur falls into this prediction trap. They study fundamentals, patterns, and reports, building a crystal ball for tomorrow's prices. Meanwhile, professionals ignore predictions entirely and focus on one question. What is the market telling me through its behavior at this exact moment? Every price movement represents real money, changing hands between real people, making decisions based on real emotions. Fear and greed haven't changed since markets began. The psychological patterns that drove speculation in Livermore's era drive speculation today. Livermore understood something most traders never learn. The market reveals everything through 3 simple indicators that require no complex formulas, no expensive software, no mathematical calculations. These signals existed when traders watched ticker tape, and they exist now in our digital age. The technology changed, but human nature and therefore market behavior remained identical. The first indicator alone will transform how you read price action within 30 days. You'll stop seeing random movements and start recognizing the conversation between supply and demand. The second will teach you when to press your advantage with surgical precision, turning small wins into substantial profits while keeping risk minimal. The third will save you from devastating losses that destroy trading careers. Together, they form what Livermore called the market's true language. Here's your first hard rule. Size from the stop, not your feelings. If the distance to your stop is $1.20 and your risk per trade is $100, you buy 83 shares, not about 100. Precision prevents regret. Second rule. Never widen a stop after entry. You can tighten it with fresh information, but never give the market more rope. Third rule. 1 signal is noise, 2 are interesting, 3 mean business. The tape, the pivotal point, and the market tide must align before you risk real money. When they don't, bank your greatest edge: patience. Counterintuitive truth. Doing nothing is often the best trade. Waiting is a position, frequently your most profitable one. But here's the catch that separates the 10% who succeed from the 90% who fail. Knowing these indicators is worthless without the discipline to act on them consistently, especially when emotions scream otherwise. Every amateur learns rules. Few develop the character to follow them when money is on the line. The market will test your discipline repeatedly. It will offer seemingly perfect setups that violate your rules. It will tempt you to risk more when winning. It will whisper, "This time is different," when you should cut losses. The tape whispers before it shouts. By the time most traders recognize what's happening, the major move is over. But professionals hear those whispers clearly. They see subtle signs that precede major movements. They position accordingly, with proper risk management, and let the market do the heavy lifting. This isn't about being smarter or having better information. Success comes from developing the ability to observe without predicting, react without hoping, and cut losses without ego. These three indicators will show you exactly how to develop that ability, but only if you commit to learning the market's language instead of imposing your predictions on it. The tape whispers its secrets to those who know how to listen. In 60 seconds, you'll learn exactly what to listen for. Livermore's first indicator was the tape, not the meaningless scroll of prices most traders ignore, but the living conversation between supply and demand, written in price and volume. The tape tells you the market's line of least resistance. Your job isn't to argue with it. Your job is to recognize it, then risk small, and align. Most traders think they're reading the tape when they glance at green and red candles, but they're missing the deeper dialogue happening between buyers and sellers. Every transaction represents a decision made by someone with real money at stake. When you learn to read this conversation correctly, you stop guessing about market direction and start observing what's actually happening in real time. Here's the problem amateurs face. They see rising prices and assume strength. They chase breakouts without reading the character behind the move. A stock can rise on desperate short covering, retail excitement, or algorithmic noise, none of which represents sustainable demand. Professionals wait for what Livermore called repeated character, sustained evidence of genuine institutional interest, not retail excitement. This character reveals itself through volume patterns that most traders completely ignore. When smart money accumulates a position, they do it quietly over weeks or months. When retail gets excited, they do it loudly over hours or days. The tape records both behaviors differently if you know what to look for. Let me share a story from 1907 that cost amateur traders fortunes and made Livermore millions. Railroad stocks were breaking to new highs, and everyone was buying. The newspapers were bullish, the fundamentals looked strong, and the price action appeared perfect clean uptrend. Higher highs, higher lows. Technical analysis suggested continued strength, but Livermore noticed something the crowd missed. Volume was decreasing as prices rose. While everyone celebrated new highs, the professionals were quietly distributing shares to enthusiastic amateurs. The smart money was selling into strength, not buying it. Within weeks, those railroad stocks collapsed, wiping out traders who focused only on price direction. Livermore had shorted the breakout because the tape told him the real story: distribution masquerading as accumulation. He saw the whispers of weakness long before they became a roar. This pattern repeats endlessly across all markets and time frames. Rising prices on declining volume signal that demand is weakening, not strengthening. Falling prices on declining volume suggest selling pressure is exhausting itself. But amateur traders see only the price movement and miss the volume context entirely. They buy breakouts without checking if anyone of substance is actually buying. They panic sell bottoms without noticing that selling pressure is diminishing. Here's your protocol for reading the tape correctly. First signal, structure. Look for higher highs and higher lows over several weeks, not just a few days. True trends develop slowly and persistently. Amateur trends spike quickly and die fast. Professional accumulation builds methodically over time, creating a staircase pattern of steady progress. Second signal, sponsorship. Volume should expand on up days and contract on pullbacks. This tells you that institutions are buying strength, and retail is selling weakness, exactly what you want to see. When volume patterns reverse, light volume on advances, heavy volume on declines, the tape is warning you that smart money is heading for the exits. Third signal, preparation. Range contraction before expansion creates what Livermore called the coiled spring effect. After weeks of sideways action on declining volume, the stock builds energy for its next major move. This isn't random consolidation, it's professional accumulation disguised as boredom. When the spring finally uncoils with massive volume, the move tends to be swift and substantial. But here's the key. It must be a coiled spring, not a messy stampede. Clean, tight ranges on light volume suggest control. Sloppy, wide ranges on erratic volume suggest confusion. Your execution rules must be precise and non-negotiable. Risk per trade, 0.5 to 1% of equity maximum. Write 1% max on your monitor where you'll see it every day. This isn't a suggestion, it's survival. Entry timing. Buy after range contraction. On the expansion day that closes near highs with 150 to 200% of average volume. This confirms that the breakout has genuine sponsorship, not just retail enthusiasm. Stop loss placement, just below the contraction floor or prior day's low, whichever is tighter. This gives the trade room to work while limiting damage if you're wrong. Position size calculation. Determine shares from risk to stop distance, never from conviction. If your stop is two away, and you're risking 500, you buy 250 shares, regardless of how sure you feel. With a 20,000 account and 1% risk, your loss budget is 200,200. If the stop is 1, 0, 0, 1, 0 away, you buy 200 shares. Precision protects you. Sloppiness invites regret and needless drawdown. Emotion has no place in position sizing. Conviction kills accounts when it overrides risk management. Pattern interrupt. No expansion after contraction means no trade. Period. If the spring doesn't uncoil with authority, step aside and wait for the next setup. Waiting is a position often your most profitable one. Amateur traders feel compelled to trade every setup they identify. Professionals trade only the setups that meet all criteria with room to spare. The difference between these approaches determines who survives and who doesn't. The tape reveals momentum and sponsorship through these volume patterns, but reading the tape is only the beginning. Where do you draw the line that separates hesitation from commitment? That's the pivotal point, Livermore's second indicator and the hinge of all great trades. A pivotal point isn't just another support or resistance level drawn by technical analysts with arbitrary lines on charts. It's a psychological battlefield where the market declares its true intentions through the collective behavior of thousands of traders, each carrying emotional baggage from previous encounters with that exact price level. Livermore watched for these moments of announcement, then acted decisively with defined risk parameters. He understood that certain prices carry more psychological weight than others' prices, where fortunes were made and lost, where dreams died and hopes were born. These aren't random numbers on your screen. They're emotional landmarks burned into the memory of everyone who ever owned the stock at those levels. The amateur's fatal mistake is buying near resistance or before the breakout. They anticipate the pivot and get chopped up by false signals, head fakes, and stop runs designed to shake out weak hands before the real move begins. They see a stock approaching a previous high and immediately start planning their entry, convinced they've spotted an obvious opportunity that everyone else missed. But markets don't reward the obvious, they reward patience and precision. Professionals let the stock prove itself above a clear level, on undeniable volume, with clean risk parameters already calculated. They never anticipate, they always confirm. This single difference in approach separates those who consistently profit from market inefficiencies from those who become the inefficiency that others profit from. Here's a perfect example from Livermore's own trading that illustrates the psychological dynamics at work. Union Pacific had fallen from 180 to 120 inches 1,907, creating massive emotional trauma for thousands of holders who watched 6060 per share evaporate from their accounts. Many sold at the bottom in despair, swearing off stocks forever. Others held on, hoping for recovery, praying to break even someday. When Union Pacific later rallied back toward 140, amateur traders assumed it would continue higher. After all, it was recovering from oversold conditions. The fundamentals were improving. The selling had exhausted itself, and momentum appeared to be building. Everything looked bullish on the surface. But Livermore recognized 140 as a pivotal point where thousands of trapped investors would desperately sell to break even. These weren't professional traders with disciplined stop losses. These were emotional investors who had suffered through months of sleepless nights, watching their life savings lose 1/3 of its value. Now, finally, they had a chance to escape with smaller losses. The psychological pressure to sell at 140 would be enormous. Every holder who bought between 140 and 180 would be thinking the same thing. If I can just get back to 140, I'll sell and never touch this stock again. Livermore shorted Union Pacific at 139, just below that critical psychological barrier, and within days it collapsed back to 110 as trapped holders flooded the market with sell orders, exactly as he predicted. The professional sees a stock approaching old highs and thinks, trapped trader exit point. The amateur sees the same level and thinks, breakout opportunity. This psychological understanding separates consistent winners from consistent losers over time. Markets aren't just mathematical constructs, they're psychological ecosystems where human emotions create predictable patterns of behavior. Fear and greed haven't changed since markets began. The same psychological forces that drove speculation in Livermore's era drive speculation today. Your protocol for identifying and trading pivotal points must be systematic and unemotional. Identification requires a minimum of 6 weeks of consolidation, or a clear prior major high that created significant emotional impact. Quick, shallow pullbacks don't create the psychological conditions necessary for a true pivotal point. The level itself equals the highest closing price within the base. Adjusted for obvious stop hunts, where market makers briefly spike the price to trigger stops before reversing. Don't use intraday highs. Closing prices reflect where serious money was willing to hold overnight. Confirmation requires a close above the pivot level, with 150 to 300% of the 20-day average volume. This ensures the breakout has genuine institutional sponsorship, not just retail enthusiasm or algorithmic noise. Execution timing is critical and non-negotiable. Enter on the close above the pivot or on the first constructive pullback that holds above the pivot level on lighter volume. This pullback tests the new support and shakes out weak hands who bought the initial breakout. If the stock holds the pivot level on declining volume, it demonstrates that selling pressure is exhausted and buying interest remains strong. Stop loss placement goes 3 to 5% below the pivot or below the breakout day low, whichever is tighter. This gives the trade room to work while limiting damage if the breakout fails. Position sizing must risk only 0.5 to 1% of equity to the stop distance. No exceptions regardless of conviction level. Here's a modern example to anchor these rules. A leading software stock builds a 7-week base between 4646 and 5151. The highest close is 50, 8050, 80, and volume dries up by 40% over the last 4 sessions, creating the coiled spring effect. On Monday, it surges through 51, 0, 0, 5, 1, 0, and closes at 51, 7, 0, 5, 1, 70, on 220% of its 20-day average volume. Professional execution. Buy the close at 51, 7, 0, 5, 1, 70. Set the stop at 49, 9, 0, 4, 9, 9, 0, 3.5% below the pivot. Calculate position size based on the 1,801.80 risk per share. With a 25,000 account, risking 1%, 250, you buy 13 white shares, 2 cent fra traven 1.12, free white 1, 13y, 2 cent fried, free 1.12, free 131, free 1.12, free 1.12, buy at 50, 5050, 50 on Friday because it will break Monday, risking 2,500, 2,500 because you feel confident. Pyramiding, adding to winning, as positions requires extreme discipline and specific conditions. Add only 20.33% of your initial position size, and only after the stock has moved plus 1R to plus 2R in your favor. Using our software example, if the stock advances to 53, 5053, 501, 801, 80, profit equals plus 1R, you can consider adding 46 shares, 33% of 138, but only if price forms a tight flag pattern and breaks higher on fresh 1.5x volume expansion. Never add to hope or to average down. Only add to proof of continued strength with institutional participation. Two maxims should guide every pivotal point decision. Pay the toll at the pivotal point, and add to proof, not to hope. The first reminds you that quality setups require patience and precise execution. You can't get professional results with amateur timing. The second prevents the deadly mistake of averaging down or adding to positions that aren't working. The market rewards strength and punishes weakness. Your position sizing should reflect this reality, but even perfect pivots, confirmed by strong volume and clear price action, can fail when swimming against a strong tide. Individual stock strength means nothing if the broader market is distributing or sector leadership is failing. A perfect breakout in a weak market is like a strong swimmer in a rip current. The technique is admirable, but the outcome is grim. The final indicator separates the professional from the gambler market confirmation and the specific times you should cut position size in half before you even click buy. Livermore never fought the general market because he understood a fundamental truth that separates professionals from amateurs. Individual stocks, no matter how perfect their setups, will drown when swimming against the broader tide. When the market showed distribution patterns, he immediately cut risk across all positions. When it confirmed strength with expanding volume and healthy leadership, he pressed his advantage with surgical precision. This sounds simple, but it's brutal in execution because it demands constant vigilance and the discipline to act against natural impulses when you've identified what appears to be a perfect individual setup. The market's primary trend acts like an invisible current. It can carry even mediocre stocks higher during bull markets, or drag the strongest companies lower during bear markets. Fighting this current is like sailing directly into a hurricane because your compass points toward treasure on the other side. The amateur's fatal flaw is isolating stock analysis from market environment entirely. They develop tunnel vision, focusing intensely on their favorite setups while ignoring the broader context that will ultimately determine success or failure. They spot a perfect pivotal point with ideal volume characteristics and compelling tape action, but they completely miss that major indices are showing distribution days. Sector leaders are rolling over, and market breadth is narrowing dangerously. The tape reading in their individual stock might be absolutely correct, but they still lose money because the rising tide that lifts all boats has reversed into an undertow that drowns even strong swimmers. Picture this scenario that destroys accounts daily. You identify a textbook pivotal point at 50 inches, a leading semiconductor stock that's been building a tight 7-week base. Your entry timing is perfect as the stock clears 50, 30, 50, 30 on 180% of average volume, closing strong at 50, 85, 50, 85. Every individual indicator screams buy. And your execution follows professional protocols. But here's what you missed while focusing on your perfect setup. The S&P 500 has logged 5 distribution days in 3 weeks, indicating institutional money is quietly heading for exits. 2 leading semiconductor stocks just broke decisively below their 50-day moving averages on heavy volume. Your stock initially cooperates, moving to 51, 20, 5, 1, 20, validating your analysis and making you feel like a market wizard. Then, reality hits with devastating force. The broader market weakness finally reaches your stock, and it collapses to 48, 2, 0, 4, 8, 20 within a week, triggering your stop loss. The individual signal wasn't wrong, your stock did have legitimate strength, but market context was ignored, and context always wins. This is why Livermore said, "I never argue with the tape, and I never argue with the market. Both must align for maximum probability." It's again, your market confirmation protocol must be systematic and quantifiable, removing emotion from critical decisions. First, distribution day monitoring forms your early warning system. Count distribution days in a rolling 4-week window, defining a distribution day as any session where a major index closes down 0.2% or more on volume higher than the previous session. This indicates institutions are selling into strength, quietly distributing shares to retail buyers who remain optimistic. When you count 4 to 6 distribution days in 4 weeks, adopt a defensive posture immediately. This doesn't mean panic selling, but it does mean reducing position sizes, tightening stops, and avoiding new purchases until conditions improve. Second, leadership assessment provides your sector health filter. Identify the top 3 to 5 stocks in each major sector and monitor whether they're making higher highs with expanding volume. These leaders typically move first in both directions, providing early warnings for broader moves. When sector leaders start lagging indices or breaking below key moving averages like the 50-day, reduce position sizes by 50% across all holdings in that sector. Leadership failure often precedes broader weakness by several weeks, giving disciplined traders time to adjust before major damage occurs. Third, trend confirmation requires monitoring whether major indices remain above both their 50-day and 200-day moving averages, with constructive volume patterns on advancing days. When indices trade below these key moving averages or show declining volume on up days, institutional participation is weak. Without institutional buying, rallies become unsustainable and vulnerable to sudden reversals. Your position size governor must adjust automatically based on these market conditions, removing discretion and emotion from critical decisions. Use full position sizes only when the market uptrend is confirmed. Sector leaders are strong and making new highs, and distribution days are minimal. This represents ideal conditions where individual stock strength aligns with market strength, creating maximum probability for successful trades. Reduce to half position sizes during mixed conditions where some distribution is present, but the overall trend remains intact. Cut position sizes to 0 during heavy distribution clusters, when sector leaders are failing, or when broad market weakness is evident. This isn't market timing, it's risk management based on observable evidence. Markets provide endless opportunities, but capital is finite and must be protected. 2 maxims should guide your market confirmation decisions: swim with the tide or stay on the sand, and the best trades align individual strength with market strength. The first reminds you that fighting the market's primary trend is a losing proposition over time. The second emphasizes that extraordinary profits come from finding individual stocks with strong technical setups during favorable market conditions. You now possess all 3 indicators that formed the foundation of Livermore's legendary success. But knowledge without integration is worthless intellectual exercise. Next, we'll fuse these 3 indicators into one complete system, your daily routine for reading markets with the same precision that made Livermore one of history's greatest speculators. Information doesn't change, accounts routines do. Here's how to thread all 3 indicators into one disciplined system that transforms theoretical knowledge into consistent profits through daily practice and unwavering execution discipline. Livermore never acted on single signals because he understood that markets are complex systems where multiple forces interact simultaneously. He waited for confirmation from at least 2 indicators, preferably all 3, before risking significant capital. This patience separated him from impulsive amateurs who jumped on every individual signal that appeared promising, only to discover that one piece of evidence rarely tells the complete story. Professional traders developed the discipline to wait for what Livermore called a confluence of evidence, multiple indicators singing the same song before committing real money to the trade. Let me show you the complete system in action through one of history's most famous trades. October 1929, just before the great crash that destroyed millions of accounts and changed American finance forever. Livermore was watching Anaconda Copper, which had rallied to a pivotal point around 130, a level where it had previously met heavy selling pressure from trapped holders, trying to escape at break-even prices. That was indicator 1, suggesting extreme caution, as psychological resistance at old highs often proves insurmountable when broader conditions deteriorate. Next, while Anaconda made new highs and newspaper headlines celebrated the advance, volume was declining with each successive rally day. Smart institutional money was quietly distributing shares to enthusiastic retail buyers who believed the new era of permanent prosperity. Propaganda, that was indicator 2, confirming his growing suspicion that this strength was artificial and unsustainable. Finally, the general market was showing unmistakable signs of exhaustion, distribution days clustering across major indices. leadership rotating from growth stocks to defensive issues, and market breadth narrowing despite rising headline numbers. All three indicators told the same story. This uptrend was living on borrowed time and would collapse once retail enthusiasm exhausted itself. Livermore shorted Anaconda at 128.128, just below the critical psychological resistance level. Within weeks, it collapsed to 7070, while others celebrated the new era and averaged down into oblivion. His success came not from predicting the crash, but from recognizing that all three indicators aligned to suggest unsustainable conditions. Your daily integration protocol must become as automatic as breathing, requiring no more than 5 minutes each morning to assess market conditions and position yourself accordingly. Begin with morning market assessment by counting distribution days in the past 4 weeks across major indices. 4 to 6 distribution days signals defensive posture, more than 6 demands standing aside entirely. Check whether the top 3 to 5 sector, leaders in technology, healthcare, financials, and consumer discretionary, are making higher highs on expanding volume. Leadership strength indicates institutional participation. Leadership failure warns of broader weakness ahead. Note each major index's position relative to its 50-day and 200-day moving averages, as these levels often act as magnets during uncertain periods. This quick scan provides your market context filter, determining your overall risk posture for the day. Watch list management requires maintaining 10 to 15 stocks forming 6-week or longer bases near pivotal points, with volume patterns showing the telltale 40-60% dry up over 3 to 5 days that precedes major moves. Set price alerts at pivotal levels but never anticipate breakouts. Always wait for confirmation through closes above resistance on expanding volume. Track each candidate's structure, sponsorship, and preparation in your trading journal. Evidence first, action second. You are a responder to market signals, not a predictor of future moves. Your execution checklist must be ironclad and non-negotiable. Risk per trade stays between 0.5 to 1% of equity maximum. Write this prominently on your monitor, where you'll see it before every trade. Entry triggers require either a close through the pivot with 1.5 to 3x normal volume, or the first low volume retest that holds above the breakout level. Stop placement goes 3 to 5% below the pivot or below the breakout day low, whichever provides tighter risk control. Position sizing must always calculate from stop distance, never from conviction level. If your account is 50,000, and you're risking 1%, 500, and the stop is 2, 502, 50 away, you buy exactly 200 shares. 500 divided by 2.5 equals 200, 500 divided by 2.5 equals 200. Conviction doesn't change arithmetic. If you can't size it precisely, you can't trade it safely. Pyramiding, adding to winning positions, demands extreme discipline and specific conditions that most traders violate through greed or impatience. Add only 33% of your initial position size, and only after the stock has advanced +1R to +2R in your favor, proving the initial thesis correct through price action. Using our example above, if the stock advances to 502, 50 your initial risk amount, in Staj, you can consider adding 65 shares, 33% of 200, but only if price forms a tight flag or secondary pivot with fresh 1.5x volume expansion. Never pyramid after a market distribution day, as broad weakness can quickly reverse individual strength. Never average down under any circumstances. This single rule will save your account more than any other. Your risk management governors must adjust position sizing automatically based on indicator alignment, removing emotion and discretion from critical decisions. Deploy full position sizes only when all three indicators align perfectly. Tape showing accumulation, pivotal point confirmed with volume, and market environment supportive. Reduce to half position sizes during mixed conditions where some distribution is present but overall trends remain intact. Cut position sizes to 0 during heavy distribution periods or when sector leadership is failing broadly. These aren't suggestions, they're survival protocols that preserve capital during inevitable adverse periods. 3 maxims should guide your daily practice. Cut losses fast, size smart, cut noise always. Add to strength or add nothing, and waiting is your most profitable position. The first reminds you that small losses are the cost of doing business, while large losses destroy careers. The second prevents the deadly mistake of averaging down or adding to hope instead of proof. The third acknowledges that doing nothing is often the best trade available when conditions don't align. The amateur sees one bullish signal and immediately buys, driven by fear of missing out and the illusion that every opportunity must be captured. The professional sees one bullish signal and begins watching for confirmation from the other indicators, understanding that patience improves probability dramatically. When at least two indicators align, you have a tradable setup worth considering. When all three align perfectly, you have what Livermore called a sure thing, as close to certainty as speculation allows in an uncertain world. Remember Livermore's final wisdom. It never was my thinking that made the big money for me. It always was my sitting. These three indicators show you when to act with confidence, but more importantly, they teach you when to wait for better opportunities. Your biggest edge isn't predicting what will happen tomorrow. It's recognizing what is happening today and having the discipline to act only when all signals align in your favor. The market will always be there tomorrow with fresh opportunities. Your capital might not survive if you ignore what these three timeless indicators are telling you right now. If these three indicators opened your eyes to how professionals really read markets, the next lesson reveals Livermore's position sizing secrets, the mathematical formulas that turned small wins into massive fortunes while keeping losses microscopic. That's exactly what we'll explore next.